Do you want to save money while taking care of a loved one like a child, a parent, or a grandparent? This video is for you. In this video, we're talking about the Dependent Care FSA, Flexible Spending Account. If your employer offers this, or if you are an employer considering offering it, here is what you need to consider. Hey taxpayers, it's Tiffany Gonzalez CPA here, a CPA with over 10 years of experience, and we're gonna break down the Dependent Care FSA just for you. A dependent care flexible spending account basically allows you to take a tax write-off first for money that you would already use to pay for the care of a child, parent, or grandparent. By putting this money in this account through your employer, right, you get this deduction on your W-2, you have a lower income, you get a write-off. And then as long as you use those funds for the qualified expenses of care, you then get the tax benefit of doing so. Now, it's important to note that if you do this route, your child and dependent care credits will be limited. Okay, so this is a credit that you get for paying for the care of your child. So you can either get the write-off, this is a deduction through the Dependent Care FSA, or you can get the credit, the dependent care credit. Now, usually, sometimes, depending on the figures, you can actually get both, but sometimes you can't get both. And let's break that down for you. So first, let's talk semantics. Your employer offers the Dependent Care FSA. You decide how much you want to contribute, and there's a maximum. You can do up to $2,500 as a single person or married filing separately, or you can do up to $5,000 as a married filing jointly couple. You then pay for out-of-pocket care expenses, right? And then you submit these expenses for reimbursement from your FSA. Some of the expenses that qualify are things like au pairs and nannies, summer camps, child care camps, before and after care. So it is very broad into what type of care. But let's talk about whether or not the person you're paying for qualifies. So the person must be a person that is incapable of self-care. This could be a child or elderly parent or grandparent. It must be a person that is living with you or within your care. Essentially, this person must also qualify for the ability to even claim them as a dependent. So you'd also have to look at the rules as to whether they qualify as a dependent. Most children automatically are your dependent. They live with you. They don't make any income. But for parents and grandparents, it can get a bit tricky if they earn taxable income on their own. It's also super important to mention that both spouses must be working or actively looking for employment. I'm going to give you an example now of what it would look like where you can actually claim both. Okay, let's say that you have two children, right? The child care credit, which we're not really talking about in this video, if you spend $3,000 on each child for childcare, you can get a credit of up to $600 each, assuming you make an average, high, decent income. So that's a $1,200 credit for two kids, right? Here's the deal though. If you instead do the Dependent Care FSA and contribute $5,000, okay, you can also get this $1,200 credit. In fact, that credit is limited to the difference between the $6,000 spend and the $5,000 spend. In other words, this child care dependent credit is only $1,000 multiplied by 20%, so around a $200 credit. Your $1,200 credit goes down to $200. But on this side, where you contributed to the Dependent Care FSA, the $5,000 write-off multiplied by your tax bracket is your tax savings. And many times that works out to being higher than the credit depending on your tax bracket. The higher your tax bracket, the more lucrative it is to go the Dependent Care FSA route than it is to get the child care dependent credit. That is very important to consider. If you're in the 20% bracket or so, it's not going to be as lucrative because the credit is similar to that percentage at the higher income amounts. But if your tax bracket is 24, 32, 37, or in this future 39, it is definitely going to be more lucrative to do the Dependent Care FSA. Because these numbers are so complex, I definitely want to recommend you sit with your financial advisor, tax CPA, and take a look and see which one is more lucrative and how this would turn out. One of the reasons why I'm not the biggest fan of FSAs is because it does have a use it or lose it rule, which basically means you must spend the money within the year, otherwise you lose it. Many times there is a grace period until about March 15th, but you can lose the money. So in actuality, you really want to make sure that that money that you've put into that account is money you would have already spent, right? If you already know that you need to spend at least $5,000 on childcare related activities, things, then it would make sense to put that $5,000 in there, make sure you do your paperwork and claim your reimbursement, you get your write-off, you get your money back in a sense, and you get the highest benefit possible on your tax return. The truth is that not many employers offer the capability of doing a Dependent Care FSA, so you do need to check with your employer to see whether that's a possibility. And if you are an employer, to check with a benefits administrator to see if that's something you can offer to your employees, as it could be lucrative and desired to retain great talent. While you're at it, hit the like button, subscribe to our YouTube channel, follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.